Hey guys, welcome to this video. So in this video, I'm going to talk about why do investors, specifically venture capitalists or VC firms, invest in high loss making companies. Now, if you see by pure business logic, if you have money and you want to invest it in a business, you will only invest in businesses which are profitable because those are considered as good businesses. But investors, VCs, they have invested historically and constantly in high loss-making companies. If you see in the Indian context, some of these loss-making companies that VCs have constantly funded over the last years are Cred, Paytm, Flipkart, Zomato. All these were very high loss-making companies and VCs still invested in them. So why do VCs do this? To understand this, we have to understand 2 points. The first point is the VC mentality. What are VCs looking for? So when a VC invests 100 crores in a company, they are not looking for a regular monthly income or a regular yearly income. That's not what they are looking for. They are looking for to convert this 100 crores into 1000 crores over the next 5 to 10 years. Over a short duration of time, they want to 10x their money. Now, how can they 10x their money? Their money will be 10x'd only when the company, the startup they have invested in, grows in value by 10x in this short period of 5 to 10 years, right? So the startup should grow from X to 10x for the VC's money to grow from X to 10x. That's point number one. That's VC's mentality. They are not looking for regular income. Now, point number two is, how do VCs select which startup to invest in? There are multiple thousands, lakhs of startups in India, right? Then why do VCs only select these small bunch of startups? And why not other startups? So, and this is very important for an entrepreneur, for you to understand, because tomorrow you might come across an idea and you want to build a company and you might need VC money. So you should understand what do VCs look for when they are investing in a company. So 3 points that VCs look for when they're investing in a company. Number one is that the company should scale very fast. This point is very logical, right? For VCs money to grow from X to 10x, that company should scale very fast so that the company's value grows from X to 10x. So a company should invest very heavily in scaling and they should scale fast. This is the first criteria that VCs look for. The second criteria is the company should be in a large market, a very large market. Because if the market is small, then no matter how much the company invests in growth, it is not going to grow significantly in terms of value. So second point, the market should be large. Third point is market itself should have a healthy growth rate. Because if the market has a healthy growth rate, then the chances of that company's growth rate to be high are even more, because the demand for those products and services would be increasing and would be more. Right? So these 3 criteria, and remember these 3 because they are very important criteria. Companies which scale very fast, large markets, and markets with good growth potential or good growth rate. Now let's take a quick example to understand all these 3 criteria. Let's take one of the most critically talked about startups today, which is Cred, which is a very high loss making startup which with negligible income, and VCs are still constantly funding Cred. Now, whether it is right or wrong is a different question. We are understanding why do VCs fund certain startups. So now if we see, Cred checks all these 3 criteria. How? Number one, is Cred scaling fast? Absolutely. Cred is investing very heavily in growth. You would see Cred advertisements with Bollywood celebs on TV, right? Catchy advertisements with Anil Kapoor, Madhuri Dixit. I think everyone has seen Cred ads. You would see Cred sponsoring IPL and I think Indian cricket team also. I'm not very sure about it, but they are investing very heavily in growth. So point number one is check. They are growing, they are scaling fast. Number two, are they in a large market? Absolutely yes. They are in the credit card market in India, which is a very large market. I don't have the exact number, but if you just Google it, you would see that the credit card market in India is huge. So criteria 2 is also checked, that they are in a very large market. Number 3, does the market have a good growth rate? Absolutely yes. To gauge this, understand this. As of 2021, India had 62 million credit cards. Compare this to US in 2021, which had 1 billion credit cards. So Indian market is just 6% of the US market as of 2021. So just imagine at what growth rate it could grow. Indian markets usually follow US markets with a certain time lag. So Cred checks all these 3 criteria, right? High scaling company, large market, and market has a good growth potential and a good growth rate. All these criteria are checked, and on top of that, Cred is founded by a very seasoned entrepreneur, Kunal Shah, who has had successful exit in the past. That's why VCs are funding it. So I hope you gained insights from this video and understood why do VCs fund certain companies and not fund certain companies. As a homework, what you could do is you could pick up 4 or 5 big startups in India today. You could take Flipkart, Paytm, Zomato, Oyo, Ola, right? And then you would see, if you do a bit of research, you would see that all these startups checks these 3 criteria which I just talked about, and that's why VCs have been very interested in them and they have been constantly funding them. So I hope you guys like this video and understood this concept well. I'll see you guys in the next video. Thank you.